So in the previous lesson, we looked at support and resistance, horizontal, dealing with just lines, just single price levels, talking about how the close levels matter, how the opens matter intra-month, intra-week, intra-day, and how a level, a support or resistance, will get stronger or weaker based upon how many times it's been tested. Now let's look at liquidity. So there's some similarities and differences to liquidity and straight SR. The most important of which is that liquidity is always an exact level. So in future, we're going to deal with support and resistance in terms of zones. The best and most common is probably like an order block that you've probably heard of. An order block is like an entire candle, which can be considered support or resistance. Well, liquidity is always an exact level because it is above or below a wick. Now, I want to clarify, liquidity can mean a different thing if you're speaking directly about a market and the level of liquidity in a market. In terms of price action, which is what we're doing here, liquidity means the highest probability zone that price will visit. Remember, like I said in the earlier lessons, in the introduction to price action, price moves through the path of least resistance to a high probability liquidity area. That is because markets exist so that traders can trade. That is why they exist. They exist for one person to be able to sell an asset to another, and over time that builds a market price, which is considered the fair value. It's a free market. Within that, you understand that markets then survive off of action. A market cannot exist without people buying and selling. So what does the market naturally want to do? It wants to move to the area where there's buying and selling. So if it's in an area that has no buyers, no buying or selling, or very little, it's going to move towards those high probability areas. And the highest probability area of all is above or below a wick. Because we know for certain there are two types of traders there. And I've talked about this again in previous lesson. We know that above or below a wick, you have one, stop losses. So people who are wrong above that level. People always put their stop losses above or below wicks. It's very, very common. So we know that liquidity is there. That's guaranteed liquidity of some form. And two, breakout traders. We know that it's a very popular and widely used strategy is to buy or sell a breakout of a range that occurs above or below a wick. So you know that at least some people are guaranteed to buy or sell there. That is why it's a high probability zone. That is why we look for liquidity above or below a wick. That is why it is always an exact level. The only minor difference will be, especially in crypto, which is quite fractured, your exchange will be different. If you use Binance or Bybit or Coinbase, obviously the exact level where that wick is will be slightly different in dollar terms. But the liquidity is the same. The stop losses are above that. The breakout traders are above that. So for the purposes of that, use the exchange, whichever exchange you're trading on, the exact level above or below the wick. So now we frame that. Now we know why that's liquidity and how that is different to market liquidity. This is price action liquidity. Market liquidity is how much buying and selling can occur at a certain price without moving the market. Meaning, how many orders are in a certain area, and if I were to put in let's say I was to put in 1,000 BTC order, how much would that move the price? That will measure how liquid the asset is. Okay, so differentiate those two. The one we deal with 99% of the time here is going to be this price action liquidity. Market liquidity is really not relevant to you unless you're trading, like on Bitcoin, you need to be trading billions for it to matter, or at least hundreds of millions. So it's not something you're going to worry about yet. I'm sure you'll all get there eventually, but not quite yet. For now, we'll stick with price action liquidity. So what are we looking for with liquidity? So unlike support and resistance, which when it comes to that level, when it comes to support or resistance, you're looking for a reaction, meaning either it will reverse or it could go all the way through it and then flip it into support or resistance. So I showed that in the last lesson. But liquidity, in terms of trading it, you're always looking for sweeps. You should know by now what a sweep is. I talk about it a lot. It's also known as an upthrust or a spring in the Wyckoff theory. A sweep is where it goes above the wick or below the wick and then reverses back inside that range. Stop hunt, manipulation, liquidity engineering, sweep, spring, upthrust. You call it whatever you want, whatever works for you. Fake out, of course, false breakout, anything you want. When we're looking at liquidity, we know the price is traveling there for a specific reason. It's going there because it knows there's liquidity. If it's going there because it knows there's liquidity, the high probability trade is a reversal. That doesn't mean that if it goes above a high that you automatically short it. It means that if it goes above a high, above a wick, and comes back below, then you have a high probability short. Okay. Same on the flip side with a high probability low and a sweep. So the best liquidity levels for short-term trading are in order of preference, so in order of strength, the previous month's high or low, the previous week's high or low, the current week, Monday's high or low, or the current week's developing high or low. That's my preference. You can use others. You can have any number of them. Again, it's subjective. What I have based this on is my experience and my understanding that other people put a lot of stock and put a lot of importance on these levels. I haven't made them up out of thin air. I know from watching the markets that if it hits the last month, previous month's high or low, the first time it hits it, it reacts. If it hits the previous week's high or low for the first time, it reacts. Once you have a Monday close and you go into Tuesday or Wednesday, once you take Monday's high or low, it reacts. And then later on that week, say you'd taken the high and low on Monday, on Tuesday or Wednesday, once you get to Thursday or Friday, if you take those highs and lows throughout the week, it reacts, especially if it's going to be a range week. How does a range week form? It goes up and down and up and down and up and down, not just up in one way. And most weeks are range weeks. So that's why the current week, high or low, can get hit multiple times, give you multiple good trades. So your liquidity levels for short-term trading are always on the first sweep, meaning if last month's high was at 30K on Bitcoin and we're now at 28K, and then we hit 30K, we go above that and we come back below, that is a sweep. That is the first test of it. That is valid. If the next week we then come up and hit that original 30K again, it doesn't matter. The sweep's done. So liquidity levels are first sweep. And the only reason for that is just to expect reactions. They are the highest probability levels to have reactions. It's really that simple, right? So now, same as before, I'm going to take it into the charts. I'll get a fresh chart and we'll look at this. And again, we want to look at monthly. So where is our liquidity? This one, and honestly, this should be a lot easier for you guys because this is a lot less subjective. In fact, there's almost zero subjectivity to it. You just say monthly liquidity is above monthly highs, key monthly highs. So there we go. There's two. For liquidity, I tend to just leave it all in the one color, but I differentiate on the time frame. To me, just liquidity is liquidity. All right. What matters is when does it get hit? All liquidity, if I consider it a liquidity level, I expect a reaction. I don't try and get too caught up on how big the reaction should be because I don't care. If it rejects and has a small sell-off, I can still scalp that. Or if it has a huge sell-off, I can still swing trade it. It doesn't matter. What matters is, are there going to be stop losses above there? And are there going to be breakout traders buying above it? That's all that matters. And we know that this level and this level are two high probability, doesn't mean 100% guaranteed, areas. Monthly liquidity, big wick there. And that's it. I'm sorry, and I've been writing SR. So let me get rid of that. Monthly liquidity, monthly liquidity, monthly liquidity. And anything else I see off the top of my head on monthly? I mean, of course, why not? For the sake of being thorough, put in that one. And I mean, you can just, especially with the monthly, you can do this once, have it on a separate chart and just have it there perpetually and just watch it in future as those levels get hit. As they get hit, watch how it reacts and then remove them or change color of them, whatever you want to do. If you want to change it to red when it gets hit so you can see how price has been at those levels, sure. Again, that's personal preference. Then we go down into the weekly, looking for the same thing again. So weekly liquidity for me, here's obvious weekly liquidity, weekly liquidity above. And that's about it for the weekly. Of course, I could go on to higher time frames for all of those, but we're looking at specifically these inner ones. And then we'll zoom in a little and we'll look at the highs and lows of the month. So this is April's high as well. April's high. That matters. Much like in the previous lesson where I talked about the current monthly open mattering, so does the current monthly high or low. So April's high matters. Where's April's low? Well, this was April and we set it here. So April's low. This isn't weekly liquidity yet. You might be asking why this one isn't, because this weekly candle, as of time of recording, hasn't closed yet. If that closes, and then we go into the next one, then it becomes weekly liquidity too. Also April's low, a solid level. So you've got April's high, April's low. You then have the current week. So then we go into our next time frame, which is the previous. We've done the previous month's high and lows, and we've done our general liquidity levels. So our swing highs, swing lows. We've done the previous month high and low. Previous week's high and low is the next one. And so the previous month's high and low, if they're untested, was actually this one. So this was a monthly liquidity and March low. So we've done current month and we're moving on to March. The March high was here and that's already been hit, so no need to mark it. And when you get these levels and have multiple, so if it's weekly liquidity and April high, monthly liquidity and March low, think of it as a stronger level or a level of more interest. There's more people, because remember, it's all about just people's perceptions. What you're saying is some people are going to view this as a key monthly level. Some people are going to view it as March's low. All that matters is that's potentially twice as many traders who consider it an important level. That's what matters to you. So that could mean twice as many stop losses, twice as many breakout traders, a lot more liquidity for you to trade into. That's essentially what it means. It doesn't have to be much more complex than that. So we've done the previous month's levels. We now do the previous week's levels. So this is the previous week. There's the high. So previous week high, Previous week's low was already taken, if you see that. So I'll just draw it here with a trend line. That was already hit, so no need to have it. And then we'll go into our daily and start to break it down into our current week. So you want to look at daily liquidity. Where is it going to be resting? Well, right away, we can see daily liquidity here. Why? Because we set a high and we've had a little bit of a sell-off since then. So we know that some people are going to be short here and their stop is going to be there. That's all we're trying to do. Is we're just trying to estimate high probability areas of liquidity. So that's a daily liquidity level. That also happens to be our high of the week. HOW, high of week. Because look, this is Wednesday. Monday was here. So that's the weekly low. That's the weekly high. So this one, which is also April's low, is our low of the week, which LOW. I guess you could mark that like that if you want to just differentiate it from the word low. That's our low of the week. That's our high of the week, and also a daily liquidity level. And then you keep going, all the way until you've marked as many as you want, as many as you need. But once you have the current week's high and low, you have the previous week's high and low, and you have Monday's as well. So this was Monday. So low of the week and Monday's low. So it's April's low, it's the low of the current week, and it's the Monday low of this week. So the current week's low was set on Monday, which is also the monthly low. That's a really significant level. If price were to trade down to that, you'd expect a strong reaction. A lot of stops going to be resting there. Now, obviously, as this is recorded, we're late in a month, so it's going to tick over soon into May, which would then, it would still be April's low, obviously, if all else remained the same. It would not be the low of the week, it would be the low of the previous week, so previous week's low. And it would still be the previous Monday's low, but that wouldn't be quite so relevant because we'd have started a new candle, and wherever that Monday goes remains. Understand? Last thing on this part, clustered levels. Whenever the lick levels are close, the reaction should be greater. It doesn't mean that a reversal is guaranteed. But if you have two levels here, to put it simply, would you want to get strong, aggressive on your buying if price did this? For me personally, in my experience, no. When you have levels close together, you want to see them get hit together or else just leave it. Because even if that reversing goes up, it's not a high probability setup. The chances are it's just grab that liquidity first, then it comes again. And so if that happens, that's super high probability because you've taken out all these people and all these people. And if you get back inside, you're essentially shooting back up with double the firepower. So your clustered levels, doubles or even triples like this that are relatively close and a monthly level above, quite often this is price building up stops, building up invalidations so that it can rip them all at once. So watch that. That's why you'd want to be very careful trying to short that. That's difficult. I don't see that as a valid way to trade. If this happens, sure, you could get a reaction back in here, but be wary when you have a lot of levels clustered together. Usually in those scenarios, patience pays. And if you wait for it all to go, you get a really good trade. If you're patient here, you didn't FOMO in here, that's when you get your best trade. All right. But that's liquidity. So then you can zoom out, you can have all your levels set. You can go in onto a low time frame. You can do whatever you want and you can watch and say, so even just looking at this, if I was a liquidity trader, and so I wasn't worried about general support and resistance, I just like to trade sweeps, or I like to see reactions at key levels, I would know that right now, currently, price doesn't interest me. Because even though there are lows here, yes, this is a low, but this is a low from Friday, less than a day, and there's not been a lot of action. Got a low here, but what good is that? What reaction can you really expect from that? You've got a low here, which might produce a bit of a reaction, but back to the principle I said before, it's also surrounded by two lows below it. So would you really want to jump in there? Or would you expect at least the next one to get hit, if not all of them? So that would just let me avoid bad trades by saying, I don't trade in here. I trade my liquidity levels. So that's it. That's liquidity levels. Use it to find high probability areas of reversals. That's all it is. The market trades through the path of least resistance to an area of high probability liquidity, at which point it wants to move in the opposite direction. And that's it. That's the lesson done on liquidity.